Welcome to my April update on alternative asset fund administrator and auditor league tables. There are over 600 fund administrators and 500 audit firms servicing the private markets. I'm George Evans from Convergence, and welcome to my monthly podcast. Convergence is a data and analytics firm focused on the asset management industry globally. Note that alternative asset league tables are available only to Convergence clients. League tables can be purchased at the Convergence e-commerce site, convergenceinc.com, and just choose the e-commerce tab. I will provide some commentary on the movement we saw from April 2020 to April 2021 and some brief commentary on those headlines. I'll be joined this month by two Convergence clients, Jason Mclinski of Apex Fund Services and Irina Gershengoren from EisnerAmper, both firms with noteworthy performance over the last year. Let me start with some comments on administrator market growth. So for the 12 months ending April 30th, 2021, advisors disclosed almost 95,000 private funds, a net increase of over 5,100 funds. That's up about 6%, and assets of close to 23 trillion, a net increase of 2.4 trillion. That's up about 12%. The top 25 administrators won 47% of about 10,000 total new funds disclosed, and all other administrators won 21%, while advisors who chose self-administration stayed at around 32%. The top 25 administrators won 53% of the 1.37 trillion in new fund assets. All other administrators won 12%, and advisors who self-administered kept that steady pace at about 35%. Convergence continues to see strong year-over-year growth in PE funds and assets, with PE funds up about 7% and assets up very close to 20%. We're also seeing that strong growth in venture capital. Funds up 20%, assets up close to 50%. Advisors over that time period disclosed close to 24,000 hedge funds, down about 600 funds, and hedge fund assets increased about 6% over that time period. I also want to make a comment on self-administration. There are almost 31,000 self-administered funds in the market. Self-administered funds represent about 32.5% of all private funds. I want to now comment on the macro league tables. We see a few trends here. Market asset growth over that last year is up about 12%. Only admins 1 through 5 are not keeping pace with that growth. They're only growing at about 5%. Administrators 6 through 10 are growing close to 18%, 11 to 25 at 21%, and 26 to 600 at 53%. So the growth down market continues. I think this is something the top 10 administrators should study. I would like to now introduce Jason Mclinski, Head of Business Development for the Americas for Apex. Apex Fund Services ranks number 11 in new funds added over the last year, up almost 11%. Its market share of total private funds is up about 2%, up to almost 5% of the market. Their success over the last 12 months has been driven by PE, VC, and real estate funds. Private assets increased almost 30%, and Apex maintains its league table position of number 14. Welcome, Jason. How are you today, my friend?
I'm well, George. Thanks for having me today. If it makes sense, I can just give a very brief overview of who I am and where I sit in the organization. I've been with Apex for a little over 2 years. Accurate, I do run America's business development, which encompasses Canada, North America, and LATAM, where we've recently made an acquisition there. The AUM or AUA, of the firm is a little over 1 trillion as a result of our recent acquisition of FundRock. And in short, if I could describe us in a sentence or less, we're really an asset servicing firm. Yes, fund administration is core to what we do, but we really offer a single source solution to the market.
All right, terrific. Well, listen, Jason, you've been a very good friend of Convergence, and it's been a terrific relationship, kind of integrating our data into your business development. A couple things I wanted to talk with you about today, about the market in general. First one's kind of basic, but you can go a lot of places with it, right? What do you think the biggest issue facing the alternative asset management industry is today, Jason?
It's a great question. This is one where you almost have to pick your, the lesser of all the evils. I think the largest one that we see is the regulatory environment and how it's both ever growing and becoming structurally more complex. And so, when I think about it, what does that do for hedge funds or private equity funds? It layers both cost and complexity into the model. So look, we work with managers to offer a way to have a single source, get all of your vendor ecosystems in check, reduce the number of counterparts that these folks have to deal with. What I think the biggest issue, if you're the client, what does it do? It gives you pause. You've got a larger number of advisors, within your orbit that you have to involve in both structuring, standing up a fund, and continuing to operate it. So what does that do? That makes time to market a much longer cycle, and we're cognizant of that. But I think to sum up, the regulatory and structure of all these funds is just making it much more complex, much more difficult to stand up. And I'll pause there for you.
I think that's a great answer. I think what's very interesting, right, in this world of 650 administrators, right, compliance and regulatory services has really been not part of the typical admin model, right? There are a handful of administrators now that have really started to make an investment in compliance and really what I would call reg tech.
Absolutely correct. From our perspective, we see it in terms of the competitive landscape when we're dealing with new mandates and the notion of compliance comes up. We've made an investment both in people and dealing with a third-party provider to do it on our behalf for our clients. But I do see that in the next 12 to 18 months, most of our competitors, and by that we'll call it the top 10 administrators or asset servicing firms around the globe, will most certainly have some kind of or some function around compliance baked into their offering without having to go to a third party. Again, it's all about control and it's all about compliance becoming a more complex process, right? And people like to put more of these things off-prem.
Yep. Okay. I totally agree with you. All right, let's move to another topic, and this is another broad one. So you can take this where you'd like, Jason. ESG, right? Impact funds, social funds, whatever you want to call it. Talk to us a little bit about how Apex is focusing on the ESG market.
Yeah, this is a big, broad one, and it's got a lot of question marks after it. So I think there's a fair amount of unknown. I think a lot, we see Apex, the driving factor for the need for an ESG framework from the manager perspective and the subsequent reporting that's driven by it is really coming from the LPs in the alts community. They're demanding it. I feel like a lot of these managers sometimes feel like they're serving a lot of different masters or many masters. The reporting is nuanced. It's an expensive undertaking to build on your own. We've done that. We do it out of our London team. They've built what we think is a superior product where we've got sort of first mover advantage, how long that lasts, no one really knows. And the way you drive having a product like that has staying power is you use your clients as an instrumental part of your product development. So we spend a fair amount of time with both new clients and prospects on what their ESG framework looks like and make sure that it's in the offering so that when we go and discuss it with the next prospect or client, that we've already thought down the road for where they may, for what need they may need to solve. It's complex, and I think the buying market for ESG product still doesn't know what this will look like in 12 months, in 24 months, but it is in every conversation we have with existing clients and new people who darken our door.
Yeah, well, listen, I think it's a smart idea, right? It's to let the client drive the product development, right? Very iterative process, and I think it's here to stay. I think it's in what shape or form it comes, I think is going to be the question, right?
Could not agree more. It'll be interesting to see where it goes, but from where we sit right now, I think we can solve most or all of our client needs. But again, you really have to pull your client base continually to make sure that you're staying ahead of the curve.
Yep, agreed. All right, let's turn to the alternative markets, and I wanted to get your view on the hedge fund market. Right, it typically has lagged for the last 3-4 years the closed end market. We are seeing some good forecasts on growth and new capital. Yet I just saw something this morning that said some of the top performing hedge funds in 2020 haven't yet performed in 2021. So interested just in what Apex thinks about the hedge fund market and your focus on that market.
Yeah, look, it's an interesting, if you look at it holistically, the hedge fund market itself hasn't made a comeback. I think from an asset raising or new launch perspective, the answer to that's yes. And how do we channel check that? Most of our hedge fund new business comes from the prime brokerage community or the audit community in terms of referral. Obviously, we layer your data into it from a prospecting perspective. I think the long short equity market in terms of launches is fairly active. Obviously, we service that well. A somewhat of a deluge into what I'll call crypto or digital asset hedge funds is coming through our door. I think there you have to really look for and be prudent around picking who you strike a NAV for. So we look for critical mass. Anything potentially over 25 or 50 million feels real. The concerns around that asset space obviously is subscriptions and redemptions into it being in fiat, not coin, from a KYC AML perspective. What's really interesting to me, what I see, and I think you got to give it a year to play out, is a ton of the mutual fund clients that we service out of our Atlantic franchise that we bought in Portland, Maine, are launching hedge funds on a side-by-side basis. So I'm really interested to see what that looks like on a 12-month look back. But these are large mutual fund complexes getting into the hedge space. The launch size is not what it used to be, and call it, if you really want to go far back, to 07, 08 or earlier, but it's still healthy. So the average launch we see on our books is slightly over 150 or 200 million, which is refreshing. But again, not to state the obvious, returns on those funds will drive the future.
Yep, agreed. I think well said. All right, last question, Jason. We wouldn't be able to do a podcast without a scandal, right? So we're going to talk about Archegos, the family office, right, which clearly set a number of firms back financially in the last month. Just wanted to get your thoughts and what your firm is doing from a risk perspective to protect itself from bad actors in the marketplace.
Sure, it's a great question, and this is obviously a popular conversation amongst both the PB community and the admin community. And so from a NAV perspective, or standing over a fund in terms of NAV production, if you will, you protect yourself by having a strong KYC AML policy. The interesting part of this specific situation, if you will, is that it was realistically one investor. So you can call it a family office, you can call it just a single investor fund, but it's not like, and this may just be the silver lining of this situation, is that it wasn't an endowment, a pension, or a sovereign wealth fund that got, proverbially speaking, cleaned out. So my hope is, from a systemic risk impact, it's less detrimental, to investor sentiment and their engagement. That said, this harkens me back to my days at Bear Stearns, if you remember them, as a risk manager in prime brokerage. And so we dealt with this issue all the time, and the devil is in the details here. There's a large key difference between a standard total return swap and a bullet swap. So I think the market going forward will have, a real navel gaze over variation margin, what the terms of the ISDA agreements that govern these things are, when you can liquidate, and just how much credit you really extend to one specific entity, and how deep are you willing to go down with them. It's a tough situation for a risk manager and a swap desk to have that honest conversation about just how much risk do we want to put on the books, and to whom. So time will tell on this one, but it is 2 to 3 times a week I'm on the phone with a colleague at a prime or or another admin, and this comes up. So,
Yep.
it's all about knowing your client.
Well, it's the old debate, right? Risk and versus return, right? The classic. So,
Well, you got to listen. As a risk manager in the past, the thing I always look at, and interesting enough, I tell my team, when you look at an opportunity, is it's great to plan and think about and rejoice about what can go right. But you really need to think about in your process, whether it's a sales process, a credit process, what can go wrong. And the hope is for all the market players involved here that everyone sort of takes heed of that, and we just get better at what we do every day.
yep, I agree with you. Well, listen, terrific insights, and really nice to have a conversation with you. We enjoy your company. We enjoy our relationship with you guys, Jason, and I really want to thank you for joining us today.
Oh, thanks, George. You guys are a great partner to us. So thanks for having me.
All right, terrific. I'd like to now discuss market growth in the audit market. And this is for the 12 months also ending April 30th, 2021. Advisors disclosed nearly 94,000 private funds. That's a net increase of about 6,000 funds, or up about 7%. Assets were reported at about 23 trillion, and that's a net increase of about 2.5 trillion. That's up a little over 12%. The top 25 auditors won 70% of the 9,700 total new funds disclosed, and all other auditors won about 6%, with the remaining 24% of funds not reporting a fund auditor. The top 25 auditors won 89% of 1.3 trillion in new fund assets. All other auditors won 2%, and 9% of funds did not disclose an auditor. Convergence sees strong growth in the PE market, the VC market, and the real estate market. The most notable growth in the VC market, where funds are up almost 25% and assets close to 50%. Funds and asset growth in hedge funds increased, with advisors disclosing over 23,000 hedge funds. Hedge fund assets were up about $500 billion, or about 6%. Funds not reporting auditors represent funds that are not subject to an audit or are in the process of selecting one. This is a big number, and the number of funds not reporting auditors totals almost 15,000 in the marketplace. I'd like to now talk to some of the headlines in the auditor league tables. We saw market asset growth year over year of over 12%. The big four did keep pace with that growth at almost 11%. 5 through 10, though, grew at 27%. Auditors 11 to 25 at 20%, and that's almost 50% greater than the market. And auditors 25 plus grew at about 21%. So clearly the market continues to spread the jam down market. I'd like to now introduce you to Irina Gershengoren from EisnerAmper. Great client of Convergence. She's been a partner over 10 years in the financial services practice. I want to welcome Irina. EisnerAmper ranks number 6 in total private funds over the last year. Its funds increased almost 32%. It ranks number 8 in total assets, as assets increased almost 16%. So good day, Irina. How are you today? Thanks for joining us.
Thank you for having me, George.
Yeah, well, we're really glad you're here. Hey, I've got a few things I'd like to talk to you about today, and really want to thank you for making the time to talk with us. Let me start with kind of a broad question, Irina, about the asset, the alternative asset management industry. What do you think the biggest issues are today facing the alternative asset industry?
I think the biggest issue facing the industry is still capital raising, due diligence, risk of unknown market volatility. There is still so much uncertainty in the global macroeconomy, such as prices of commodities, and after a year into pandemic, the virus is still a global issue.
Irina, let's go to my second question, and it's a very broad topic, right? ESG, impact funds. What do you foresee as, on the ESG front in this industry? The whole field for Eisner. I'd be interested in your thoughts.
The field of ESG-based investing has been growing quickly. EisnerAmper recognizes the importance of ESG and D&I, and we're working with clients with such mandates. Not many CPA firms offer expanded consulting services to address ESG, the development of social responsible business models and practices. Investors are demanding transparency, accountability, verification, and results in businesses are struggling to find professional guidance and support.
Why do you think ESG is such a hot issue these days?
I think more investors want to see their money invested in stocks, funds that are both profitable and reflective of their social values. As the younger generation is entering in the field of investing and gaining the active interest in their money goes and how it's impacting the world. Many people expect ESG trends to become more important under Biden administration. The White House is focusing on policy transition to a green economy and addressing inequalities across income, race, and gender, which will increase the spotlight on ESG-focused investments. Many companies are seeking ways to be part of the movement and are willing to alter their business practices and organization structures to do so. Business owners are more committed than ever to aligning their business operations with their personal values and principles and those of their families.
Okay. So I agree with you, Irina. I think it's a very big trend. It's being, defined differently by lots of folks, but I think the younger generation is really influencing kind of this active interest in ESG. All right, let's talk a little bit about the alternative markets, right? And as you know, over the last few years, closed-end funds have really outpaced the hedge fund market. But I think there's a lot of folks that believe there's a real resurgence of hedge funds. I'd like to hear your thoughts on the hedge fund market.
There's an increased number of hedge funds began reporting. Q1 hedge fund statistics shows all-time record high, signaling that the money is flowing into businesses as it affects the coronavirus outbreak slowly fades. 2021 is shaping up to be a very good environment for hedge funds managers, as managers focus on on fundamentals. Recently, we see more master feeder structures versus standalone funds, larger AUM size at launch. Hedge fund managers are optimistic about 2021, not only because it's favorable market conditions, but also due to interest from institutional investors in using hedge funds as alternative to low returning fixed income strategies. As many institutional investors were unable to meet allocation goals in 2020, since they could not conduct the normal due diligence procedures, they feel that as the world starts to open up, increased allocations will start to flow into alternatives again.
All right, I agree. I think we're seeing, just even in terms of a capital formation, just a lot of new flow into the hedge fund market. All right, now the alternative industry, or really the asset management industry, really wouldn't be the industry without a scandal. And I wanted to, the latest and greatest is Archegos, and really like to get your thoughts, Irina, on the risk here and what your firm's doing to protect itself.
We're enhancing our use of technology, analytics, and external research tools as part of our audits, looking for risk embedded in the portfolio. We continue to see institutional money manager adding middle office and internal audit capabilities to reduce risk embedded in their portfolios. Some of these capabilities can be outsourced to independent service providers as well.
All right, I agree with you on that risk front. So lastly, just wanted to get a sense of any other topics or trends that you'd like to mention from an Eisner perspective.
Sure. I think venture capital market is strong. A lot of capital going into this strategy. Venture capital funds posted higher returns in 2020 than other private market strategies. 2020 has been a year like no other, and alternative investment industries has felt the impact. But despite its challenges, the industry has proven resilient and adaptable to a new work environment. During the first half of 2020, there was strong decline in PE deal making. Transactions were put on hold while GPs shifted their focus towards stabilizing existing portfolio and providing operational support. As COVID-19 started to accept the new normal, PE investors turned their attention back to executing deals, leading industry into strong rebound in the second half of the year. 2021 could be a year of robust deal making. The pandemic exposed a great deal of liquidity as well as a number of underperforming private businesses seeking capital injections. Private equity and venture capital investors are optimistic about deal activity and are deploying capital that they could not have put to work last year. The pandemic has opened many opportunities in sectors that have been positively impacted during the virus, such as healthcare, technology, life sciences, home delivery, and information technology.
Well, I agree with you. There's a lot of dry powder out there, and I think there are a number of industries that this whole COVID situation has really created extraordinary circumstances for. So, Irina, I want to thank you for joining us today. You guys are a terrific client of the firm and friend of the firm, and just thank you so much for taking the time to speak to us today.
Thank you for having me.
All right. I'd like to give a summary of a few things we heard from our guests today. Number one, post-COVID, a more structurally complex market. Additional layers of costs being added to operating models and to the regulatory framework at advisors. The second point they made around post-COVID was unknown market volatility, that there's really people on both sides of the fence in the market. Second topic that I thought was interesting today was ESG. Both firms felt it was really key to new business, and it is really all about a younger generation investing with impact. Thirdly, the hedge fund market has historically been lagging the closed-end market. Both firms felt that the hedge fund industry was on a comeback, and Eisner even cited record high hedge fund activity in Q1 2021. We discussed the Archegos scandal and the impact that had on their firms. And like many, they're looking at embedded portfolio risk, and they are anticipating, significant changes in and more stringent risk structures in many firms. And then lastly, we really just talked about the alternative markets and how resilient they are. Private equity is back to deal execution. There are many opportunities in new sectors that were made much more prominent during COVID, like life sciences and home delivery. So I thought it was a terrific conversation, terrific guests, and I want to thank you all for joining me this month, and I look forward to seeing you all in the month of June. Take care.